Hi, everyone. My name is Weston Walker. Welcome to the Capital Raisers Show. Today we have Matt Strong. He has done over 450 flips, 300 value add single family in Utah. He's done over 1,400 private hard money loans. So, Matt, welcome to the show. Shout out to our sponsors, Family Office Club, Capitalist Pro, and Invest Next.
Right on, Weston. Good to be with you.
Yeah, good to be with you as well. So, Matt, give us a little bit about your background. You're in investments, brokerage. Seems like you're doing a whole lot of stuff. So, give us the rundown of how you help people.
Yeah, my main focus over the last 18 years has pretty much been in the residential, single family, duplex, fourplex world. 90% of everything I've done has been in Utah. I started as a fix and flipper, just buying bank-owned distressed houses, and I've still always done that. Some years we did a lot more volume than others, and along the way I raised money from private high net worth guys that would fund my flips, and at some point, we generated enough extra money, or they were successful in their businesses, so they had extra funds, and a couple of other investors came to me and said, hey, where are you getting your money? And so that kind of turned into brokering, private hard money, however you want to call it. And over the last probably 10, 12 years, that has now become my main focus, where I am a hard money lender, where I'm putting together short-term bridge loans for other local real estate investors that are buying and fixing and rehabbing and flipping houses. While at the same time, I've continued to do that. I have a team built out for that, but my main focus is the hard money these days, as well as along the way I've bought and held different commercial, retail, commercial office, small apartments, and then a bunch of, single family 1 to 4 unit residential holds.
Awesome. Yeah, so you mentioned raising capital for all your investments. I'm assuming you use your own money as well. So how do you find the money that you raise from investors, and then what exactly is the pitch when you give them the opportunity?
Yeah, that's a great question. So definitely along the way, I look back at my first small couple deals that I ever did before I had really the confidence or access to other people's money, is I just used my home equity line of credit, to fund our first flip. Now, back then, I think our purchase price was like $70,000, so I had enough. I had like $100,000 on my line of credit. And so that worked well enough. But what I noticed is, if you can show a little bit of a track record and a little bit of a history of what you're doing, it's that much easier to then go and ask somebody if they'd be interested in participating in the next deal. And for me, that was not only I needed to prove it myself, but then it also gave me the confidence that it's well, okay, I didn't lose my money. This worked. I bet I could do it with someone else's money and do 2 or 3 or 4 at a time, instead of being limited to just using my own funds and doing maybe 1 at a time. And so part of it was just having the internal confidence to go and ask. And then how I first raised money was really just from my initial close circuit of, it was actually an old boss that we left on a good note and still had a great relationship. And he was a successful business guy, and we knew and liked each other, and it was a simple enough structure for him to understand what his risks were. He was a first lien position, and if I didn't do what I said I was going to do, it wouldn't be ideal, but he could certainly just always take the property back and navigate his way out to get his capital back. But that's how it really started. And then over the years, it's just compounded, where new relationships that I've met, existing relationships, a lot of my investors and the people that invest in the different projects that I've done, a lot of them are referrals from my original sources of capital. And then what's been cool is the track record and your performance. It just continues to build and give confidence to the model. And, most of my guys I've been working with for, 10 to 15 to 20 years. And I haven't, and my pool of investors have grown, but it's really grown from inside of my existing network, and then just over the years, word of mouth, and your more successful people hear about what you're doing. And a lot of times it's people are asking, hey, how can I get involved in your next deal?
So do you think it's mostly word of mouth and in-person events, meeting people from your existing network? Or do you have like an online system? Some people do social media as well. Is that something you look into, or is it just mainly in person?
Mostly in person, and like you said, it's a lot of relationship building. So it's in person, it's reaching out and having, strategic but natural, like lunch or breakfast meetings, or just connecting, asking what they're up to, sharing what you're doing. Now, I have started, with the help of an assistant, to experiment a little bit in, putting out there on social media, like what I'm doing, how I'm doing it, and I have had I've had 2 or 3 people that were in my existing network that I'd never really talked to about doing this reach out to me and say, hey, I want to get on some of this, send me one of your next deals that I can be involved in. So I am experimenting a little bit with like that, but I've never done a formal, I don't have like a fund set up. So I've never raised money through like a fund or any sort of where it's not people that I generally already know, or it's people that know people that then introduce me to their network.
Got it. So how is that structured? You do single family, you also do hard money loans. How is that structured? Like, what are the fees? And then how is it structured?
Yeah, so let's first talk about the borrowing of money. It's like any real estate deal. I think the closer you are to the seller, to kind of go down a little bit of a analogy, the closer you are to a seller, whether it is single family or commercial, more likely the better deal and terms you're going to get, because there's not a lot of competition. Meaning, if you're buying a house on the MLS or on the public offering, you still probably can find a good deal. But if you're the one directly negotiating with the seller and they're not necessarily entertaining other offers, odds are you're going to get better terms and a better deal. I think it's the same thing with money. If you're borrowing directly from the person that has the money without a lot of middlemen in between, odds are you're going to get better terms and better rate of return, as well as your investor's probably going to get a better yield as well. So what I found is it's really, really hard to get too much less than 9 or 10% when I'm borrowing money, and that's net. I'm not necessarily paying any origination fees or anything like that. And then they're getting paid out 9 or 10%. My deal flow has always been really, really consistent, and in 20 years I've never lost any investor's principal and or interest. That's always been paid back. So that's another kind of golden rule, is never lose your investors' money. I've had plenty of deals where I've lost a lot and I've always just ate it, even on when I'm doing my own deals or when I'm lending, brokering in the hard money, other people's money. Don't ever lose their money or their interest, because then you don't have, they're going to lose confidence. Then you have to go out and re-raise from a whole new set of investors. So consistency and preservation of capital, which also means you got to have pretty sound deals, right? And mine, I would say, are probably some of the more low risk one, because I put my investors in first lien position with a deed of trust, a promissory note, a personal guarantee on all of my simple flips. So it's not equity that they're doing. It's not syndicated with 5 other investors on the same deal. They're just in one deal, one investment at one time. Even though they might have multiple different properties that we're working on, they're isolated just to, they're not shared with a bunch of other investors. Now, that's on when I'm borrowing. Now, when I'm brokering and doing the hard money, obviously there's got to be some arbitrage in the middle for me to make money and make it worth our time to do it. And so it's very common. It's probably different throughout the country, but not way different, where I charge a 2% origination fee and a 12% annual interest rate to my borrowers. And that's kind of the going rate, and has been the going rate, at least here in Utah, for the last, as long as I've been doing it.
Got it. So do you have any partners, or is it just yourself?
Yeah, I have some partners in the sense that they help throughout the process in like the back end accounting and, attorney services, title work, legal, stuff like that. So I have retained a law firm that really acts as my, kind of legal counsel on all of that. But for the most part, my lending's just been a compilation of me getting out there and networking with the community and other investors, and then through my own sources or from referrals, generating a base of investors that believe in what we're doing and help fund my loans, which then of course fund the deals for my, borrowers. And I do put a little bit of my own money in on every single loan that I do. So I've got skin in the game. My borrower's got skin in the game with the down payment. And then of course my investor is funding, the bulk of the loan, but they're pretty well protected because of the skin in the game by myself and the borrower, but also the value add nature of like a fix and flip type setup.
For sure. Yeah. So let's go back to capital raising for a bit. How does the first conversation look when you go pitch a new investor? I mean, you mentioned you have a lot of investors come from referrals. So a lot of people just go to investors and pitch them the deal, show them the pitch deck. Do you seem to ask them questions, find out what they want first, or do you just hard pitch them?
Yeah, I would say I don't, maybe I have and didn't realize it, but I don't think I've ever hard pitched anyone out of the blue before having like some basis one of a relationship with them. And even if it's just a relationship of like, hey, I know Jim really, really well. He says he's been doing this with you for the last 5 or 6 years. I'm kind of interested. I have some extra money. Tell me a little bit about what you're doing. And so it's more of a soft pitch, and it's more of just a discussion of saying, hey, this is kind of how we're doing it. This is how it works. And then I will make an invitation and say, if you're interested, why don't I send my next deal to you that you'd have enough time to kind of evaluate. And, during that time, I'm asking them, of course, like you mentioned, like, well, what's kind of your risk profile? What do you like doing? What have you done in the past? And sometimes it's really more of a conversation about educating just how this world, my world of lending works. Like the perspective of my borrowers, the value add, the worst case scenario, like what happens if we have to foreclose? How many times have we had to do that? What's their role when it doesn't go to plan? How is their capital preserved? And then what I found is once I get them in maybe once or twice, it's that whole confidence thing. Now they can see how it works. They see that it's real. They get their money back, and then then it's deal flow. If I have enough deal flow, I can usually get another deal right in front of them when one pays off. And then it's usually they just keep rolling it from deal to deal.
Yeah, so I talked to the co-founder of, I won't mention the group because he said not to mention the group, but a $28 billion real estate fund in Utah. And he mentioned that to start in the hard money space, to loan money, because if you raise for a deal, say it takes 5 years, they have to wait 5 years to get their money back. If you can give it back in 6 months or a year, it might be easier to flip that money. You get more referrals faster, easier to build a business. So do you find it easier to raise capital for hard money loans compared to the single family rental space?
Yeah, and part of that is I've really only syndicated a couple of deals where they were buy and hold, like a commercial retail one that we did up in Park City. That was more of a, we raised $4 million from limited partners in a structured, new syndicated deal that had GPs and LPs. And that was a little different. The way that I do my lending, it's really all one-off trust deed investing. So like I said, I don't have a fund structure. If you, Weston, want to invest in one of my loans, and at any one time I'll have over 100 of them going, I would just put you directly in and we document you in that loan. When it pays off, you could take your money out or you could hang tight, and usually within a day or two, I'll have another deal that could match up with your funds and roll it right into. Now, my model, honestly, is probably not sustainable if I were to get too much larger. Like, there's no way our model would work if we had, $28 billion. It would be ridiculous. It would be an accounting disaster. Like, we'd have to have a more sophisticated fund setup, I would bet. And but my investors, their redemption is like they got to stay in as long as one of the loans outstanding. But as soon as that loan pays off, like I said, they can roll into a new one. So it does provide, my model provides a ton of liquidity for my investors. They're short term. My average payback is about 8 months right now. And so, I have one investor that has about 16 million, and it's just like, he's getting paid off 2 or 3 times a month, and then he's funding 2 or 3 new deals a month.
That's awesome. Is that a family office investor?
I mean, he's probably could be considered a family office, but I don't think he's quite formalized, or he doesn't really call himself a family office. It's just, I won't use his real name, but it's just Todd, that was super successful with everything he's done, and so, and I know my guys there, a lot of guys tell me that I'm kind of their lunch money and their base hit type investments. So they definitely, and I've even done other investments with some of my investors, but my guys, it's just steady Eddie. We're just hitting a lot of base hits, but over time, if you're earning 9 or 10%, and I guess I could say zero risk up until now, no one's never not gotten back everything that they were promised over the years. And so it's a pretty risk-free, safe thing, because like I said, if a deal goes bad, you're the only one in that deal. It's most likely a single-family home somewhere where people have lived for 10, 20, 30, maybe 100 years. That home is going to be a rental. If the market gets soft, no big deal. We'll just wait it out a few years and then wait till that value comes back. But there's so I'm very simple in the way that we do it, but a lot of simple base hits do add up to be a pretty good little business as far as how we have it structured.
Yeah, and that seems like a really attractive business model, because if you lose investor money, they lose trust. They tell other people they lost money with you. So is that the main reason you find this business attractive, the hard money space, or is there another reason?
Yeah, part of it, I just kind of fell into it. I didn't know what I was doing when I was starting, and then the more that we've done it, I've gotten better about having better systems and processes, and software to help track things, and different ways that improve the efficiencies. But it's just so it's just there's a house, there's a value, and as is value, there's a future value after it's rehabbed. And not that some deals don't not go the way that you think. Like I've lost a little bit of money doing this when values kind of went down, or maybe the borrower didn't turn out to be who they said they were. Maybe I funded a little bit more than I should have, but I don't honestly know a different way. Maybe there is a different way, and I've never been super comfortable scaling and building out a huge team. The volume that I've done over the years, I've pretty much been able to do it, with myself, at times an administrative assistant to kind of help with some of the paperwork, and then my legal team, really.
What do you think held you back? Like, what's the main reason you didn't build out a team?
I don't know. I still think about that all the time. And it's maybe not, maybe it still could be in the future. I struggled, I go to a lot of business coaching groups, and I only started doing it like 8, 9, 10 years ago, like Strategic Coach, and there's another one called Genius Network that really helped me understand. I was kind of that rugged individualist where it's like, I'll just do it all myself. I just don't think I knew any better when I started, and that was not innately ingrained in how to really scale and have a team with defined roles and systems and processes. So maybe I still have a little bit of a limiting belief, or I'm still a little bit afraid of it, but it's also been a great lifestyle, and it's been something with super, super low overhead, and you can pivot really quick. I think the abundance, and I've also seen from bigger funds, they can raise more money, but with that it becomes more complex, and I can beat almost any institutional investor that comes into Utah that wants to try and fund one of my fix and flips. Like, I can say yes over the phone, and we can fund it the next day because I know the market so well. I don't need to have another department approve, the appraisal, or so I am limited that I probably am more hands-on, but I can be very nimble and very quick in my decision making. And so it, just like it gives my investors confidence, it gives my borrowers confidence that like, I may not always be the cheapest, but they're like, hey, we got to close in 3 days. I know XYZ institutional fund, there's just not a chance they'll be able to do it because they're going to want an appraisal. They're going to want, all this underwriting. They're going to want, and so I can move fast. And if I grew bigger, I could probably have more money out. I could probably reach new markets, but I think I might be a little limited. Now, on the flip side too, I don't really have a business, at least how it's structured right now, that I could sell, which is kind of a negative. So that's also something that I, need to work on. But it's also about lifestyle. I'm pretty content and happy with how this is set up, and it's worked for me, and there's no reason why it can't continue to work, for another 5, 10, 15, 20 years, however long I want to keep doing it.
For sure. Yeah, and your investors trust you in the process. You get a lot of repeat deals. Let's talk about what you look for in investment opportunities. You do hard money loans, you do single family flips. What criteria do you look for an ideal investment?
Well, I did the Masters of Real Estate Development at the University of Utah like 10 years ago. And that introduced me to, a concept that's been out there forever, but I just had never thought about it this way, about like, what's your discount rate? So if my discount rate, or the rate of return that I can earn on my money for maybe not taking an enormous risk, and it's something that I understand, that's something that's like an investment that's readily available, like take someone that's really conservative, I don't know, I'll even, that their risk level is like money market rates. So whatever those are right now, like 4%. So if you're looking at an investment that would be perceived to be extra risky, that would pay you, say, 3 or 4%, why in the world would you do that if your risk profile is, just T-bills or a money market account or a CD at your local bank or credit union? So what makes an investment to me? So say I'm looking at an investment that maybe is an equity deal, that the upside, the projected pro forma is maybe like 11 or 10%. Like, to the guy that's getting 4%, that's probably something that he should consider and analyze to see if that's worth the risk. But if I can deploy my own funds at 2 and 12, with an APR each year at maybe 14 or 15 or 16. Now, again, I'm being active in that role to earn that return. Why in the world would I invest in something that wouldn't at least get me that? You know what I mean? Like, so you got to look at the risk of the deal and then how active you are in participating in it. Now, I can see a future when I want to kind of not be as active. I will consider other investments where I can maybe just invest in a fund. Like I'm considering 1031ing some money that really I couldn't do in my real estate lending into a self-storage fund. And that one's intriguing to me because it's like, yeah, okay, cool. That looks like you might make 10, 11, 12%, but I wouldn't have to do anything. Another operator is going to be doing all of it. But I am in a riskier position because my money, along with all the other investors, would be subordinate to, a bank loan that would be in first lien position. So I think when, to kind of hopefully answer your question is I trust my model. So until I can find something, especially while I'm still being active, where I could, make more by not being as involved, I think I'm going to choose what I'm doing because I can manipulate and get a higher rate of return than probably most people can, just by the nature of my business model. But the other thing you want to look at is who you're doing it with, the operator of that investment, their track record. I did just redeem. I had a guy that I met that I put a small amount of money with, and he was doing some, like equity trading, but it was with like a little bit of AI and algorithms and stuff like that. And I had 50 grand with him for 2 years. And after 2 years, I'm like, yeah, it's gone up, it's gone down, but it's back basically to what it was when I started. I'm like, what am I doing? Like, let me redeem that, and I'll just, at least I know I can lend that out and consistently get a better return doing, my own investments.
Yeah, especially when you're active too. A lot of people don't consider if you just put a little bit of work in, you can get 5, 6, 7, I mean, sometimes 20% more if you just put work into it. You don't have to be passive in investments. So you talked about the discount rate. Is there anything you look for at the property level?
Well, yeah, definitely. I mean, anyone can go out and buy any property right now. Like, let's say you're just sitting on just piles of cash. Real estate's so great. If you're in a good market where the demographics are strong and long-term outlook is there's always going to be more people coming into the state than leaving the state. The economy's good, like I would say Utah is. You could be the smart. You could look like the best real estate investor on earth if you just, even if you're buying stuff at full market value, even if you bought hundreds of properties, say at the peak in 2007, if you just held on to those, you're looking awesome because things have appreciated. Now, when you're playing with debt, you got to hunt for value, and so that's the name of the game. Specifically in my business is when I'm going out looking for a deal, I've got to find value, meaning I've got to find a property that needs some love to it, whether it's been, distressed financially or, maybe bad decisions or, just bad luck by the current homeowner. Like in real estate investing, divorce, drugs, death, all those things are really good, because usually that means that there's a property that has different, conditions around them that are forcing the seller to sell it for less than what market value is, because maybe they don't have the money to do the repairs. So what I'm getting at is you're looking for value, either value you can create or value that can be given to you by negotiating. Let's even say you have a seller that the property actually, if they had more time, they could get full market value, but for whatever reason, they need the cash immediately, like in a couple days. They're going to give a discount for speed, and so I've bought properties that, closed on in one day, or there's properties where it was so much of a disaster. Maybe somebody it was, trashed over the years. Maybe it was a rental and it had so much upside, but it needed a lot of work. So that's where you either create the value or you negotiate the value with the single families. Now, I've also had a ton of success in finding value in multifamily where, you buy them. It's that classic story. Maybe it's in good condition, but it's not managed correctly. You buy it, you increase the rents, and some of it's just luck. Like, we saw that during COVID. Anybody that was buying apartments or whatever, all of a sudden now cap rates just went down so low, and you bought it at a higher cap rate and improved rents, got debt better. I mean, millions and millions were made, and now we're seeing the effect of. So, I guess you got to realize what your resources are. If you're borrowing at debt, you got to be a little bit smarter, and you've got to be a little bit more calculated in the deal you're getting. And the other thing that, like, I've never been trying to deploy millions and millions of dollars. There is a difference, and I'd be interested to go back and watch some of your episodes with, say, the guy that has the $28 billion fund. They can't deploy money like I do because I'm deploying smaller amounts of money. Like they've got to be looking for deals that are like you can chunk 40, 50, 100 million at a time.
Yeah, because they have different departments. I mean, they probably move slower than you do in the lending side. I mean, they have venture capital, they have the lending side, they have acquisitions, all of these different departments, and they probably buy at market value.
Yes.
I mean, because they have so much money to deploy, and they're in the fund model where you're in the syndication, you do it on a deal-by-deal basis. So I guess there is some flexibility there.
Yeah, there is, and their cost of capital is way less than mine. Their time horizon and the way their fund structure is way longer than mine. And they've got to be writing checks for, millions instead of a couple 100,000 on just a single family. So what I've seen over the years too is you can make a greater rate of return with a smaller amount of money, but it's harder to get that consistent higher return with larger dollars because like you said, you've got to, I mean, I've got friends in the, that do large volume commercial real estate deals, and sometimes they're just buying up a market value, but it still is a deal that makes sense because their cost of capital is so low, their efficiencies, their operations are so great, that they can still turn a buck in 5, 10, 20 years.
For sure. Yeah, Warren Buffett had that issue when he started making billions and billions of dollars where he could only invest in the bigger companies.
Yep.
Because he was earning 20% at the start, and then later he had billions to deploy, and he could only invest in maybe 5 or 10 companies that he thought were a good value pick. So yeah, a couple questions to wrap up here, Matt. Appreciate you coming on. What is the best way, the number one way to raise capital in your opinion?
For me, I think it's do what you say you're going to do, and if something goes off script or it doesn't go to plan, communicate. You got to communicate, and you got to be very transparent with your investors and also with your borrowers. Treat your number one philosophy as preservation of capital. You're not going to survive if you're hiding things from investors, and also don't treat the deal with I've fallen into the trap, not that but sometimes you want the deal to be a deal when it's not a deal. So you got to make sure you have sound underwriting. You're looking at deals logically without a lot of emotion. But I would say at the end of the day, it's communication. Don't lose their money. Be honest. Be moral, ethical, and legal. And then after all of that, if you're smart and you can move fast and you hustle, then you could. The sky's the limit for what you're doing. But if your foundation is set on some sort of deception or sneakiness, yeah, you may do a few deals, but you're gonna flame out pretty quick.
Mm-hmm. What's the best thing to look for in a sponsor?
Oh, I think their track record. I think if kind of goes back, are your interests and values aligned with theirs? That doesn't even mean that you have to agree with them on every part of life, but if they're honest and if they're trying and if they have good systems and teams in place and if they have a good track record, that's the bulk of it. And if you're meeting someone for the first time and you don't know them, that's kind of hard to do. But you mentioned one of your sponsors, the Family Office Club. A few years ago I went in on a deal with them and I was so impressed, and they even referred me some other investors that might be interested in investing in some of my loans. The level of due diligence they did on me was impressive. They did background checks, they did credit checks. I was like, wow, do you not trust me? And I'm like, no, they're taking it serious. They're making sure that they're trying to deal with people that are reputable. There's bad characters all the time, but I just look for people that have the same fundamentals, but hopefully they have a better skill set. It's like sometimes you think all doctors are the same or all NBA or NFL players are the same, but even when you're at that elite level, they're still way smarter, better people. So the hope is that you're dealing with people like that, depending on what level you are, that still have your same morals and ethics and philosophy.
Absolutely. Yeah, it's a big jump from being an amateur in any sport to a professional. I mean,
Yeah.
I play golf, I'm in college. And the jump it takes and the amount of work it takes to get from amateur to pro is ridiculous. I mean, it turns into a full-time job times 2. It's insane. So one last question here, Matt. What's the best real estate or business book you've read?
Oh, there's so many that, the classic that everyone says when they start out reading, Rich Dad, Poor Dad. I really like Gary Keller's got one. It's a blue-looking textbook, The Millionaire Real Estate Investor. I think that one's a great one for people to grab and read because it really will help you understand, how cap rates work, how debt works, how the time value of money works. So, I mean, there's a gazillion that are really, really good, but those are maybe 2 that come off the top of my head. And the Rich Dad, Poor Dad's great because it instills kind of maybe a new mindset for people of how to grow money. The Wealthy Gardener's a good one. Justin Donald, what is it, Passive Investor or The Philosophy of Money? I don't know. There's so many that are so good, but understanding your relationship with money, your risk tolerance, and just believing in abundance that there's plenty of good deals out there and plenty of people that want to participate in those deals with you.
Absolutely. So yeah, Matt, how can investors get in contact with you?
Yeah, and I don't know if you'll share my contact info, but usually I'll just give my cell phone, 801-244-3888.
Sounds good. We'll put that in the description as well for the investors. Matt, thank you for coming on.
You got it, man, and good luck with your golf game.
Thank you.
All right.